Up next, we have with us Stephen Bigalow. Stephen possesses over 30 years of investment experience beginning in 1976, including 8 years as a stockbroker with major Wall Street firms. He holds his business and economics degree from Cornell University and is the author of 3 top investing books: Profitable Candlestick Trading, published by John Wiley and Sons in January 2002, and a second edition in 2011. The High Profit Candlestick Patterns, released in 2005. His latest book, released at the end of 2010, Candlestick Profits. Steve is an active member of the American Association of Professional Technical Analysis and affiliate of the Market Technicians Association. Today, Steve's going to be showing us how to build gap trading strategies.
All right, well, thank you. Let me flip this back to the beginning. Let's see, how do we do this? All right. Okay, the first problems I usually have is seeing what the questions are, so I'm going to try to do that. There we go. The first thing I usually ask everybody is how many people have seen my presentations in the past. And let me see if let's see. I don't know whether I'm trying to pull up the chat so I can see the questions. Okay, hold on. I've goofed everything up then. Questions. All right, let's get this one up. Okay, so most everybody has seen the presentation before, so that will let me know how fast or slow we need to go. Anyways, what we're going to do today is, obviously, I feel candlestick signals work, or I wouldn't be doing them. They do work, because when I started as a stockbroker back in 1976. I was one of the worst investors in the world, and I was even a stockbroker. When candlesticks came along, it just made pure common sense. Go as fast as the slowest link. Unfortunately, we're going to go pretty fast. So what I discovered is, out of the 50 or 60 signals, there was about 12, what I call the 12 major signals. Now, I've written 3 books, and it was nothing more than, the nice thing about candlesticks is it's just a common sense investor perspectives put into a graphic depiction. My first book came out in 2001 through Wiley and Sons. I since have written High Profit Candlestick Patterns. And then one thing that I discovered that that even if you have the best trading method in the world, if you don't have your emotions in the right place, you're not going to make any money. So I wrote this book, Candlestick Profits, and basically what it is demonstrating is that candlestick signals and patterns, just the concept, will help you keep your emotions out of your trading, which we know is probably the biggest bugaboo for candlesticks. So what we want to learn is the simple logics that are built into a gap using candlesticks, and be prepared for those big, huge price moves. So a lot of people, or I say a lot of people, through the years, I've heard so many money managers say, stay away from gaps. You don't know what's going on in the price movement. But what I've discovered is, if you know what is incorporated as far as investor sentiment, which is the nice thing that the Japanese rice traders have done for us over the last 400 years, is not only did they identify what the patterns look like, but they told us what the psychology was that created those signals. So if we know what the psychology is that created the signals, and we incorporate that with the gaps, we have an extremely high-powered analysis of what prices should move. So the first thing I show people before we even get into our candlestick signals by themselves is the candlestick signals with the T line. And the T line is the 8 exponential moving average. We call it the T line, which is short for trigger line. And it basically boils to one very simple rule. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. Conversely, if you see a candlestick sell signal and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. This takes a lot of the emotions out of your trading, because I made good money by trading the signals and patterns by themselves. But when we incorporated the T line into our trading, it just it improved the returns dramatically. So what are we looking for when we're looking at the signals and patterns? Like any trading method, we're trying to find those big gain situations. The nice thing about candlesticks is this is the graphic depiction of what goes on in human emotions. And I tell people prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's all that the candlestick signals charts do, is they show what's going on in human emotions. And I can guarantee you there's only been one consistent factor since the beginning of investment time, and that's human emotions. So do we always get big gains like this? I always illustrate this chart because we did get these gains. Definitely not. But the benefit of candlestick signals and patterns is it puts you in situations where the probabilities of being in a big price move are extremely strong. So the definition of a gap, the Japanese rice traders call it a window, and it's basically where any of the trading range of the previous day doesn't overlap any of the trading range of the next day. This usually creates very powerful situations. There's 4 basic gaps. There's a gap up at the top. There's a gap down at the top. There's a gap up from the bottom, and there's a gap down at the bottom. Each one of these have valuable pieces of information, and when you incorporate it with candlestick signals, it gives you an extremely accurate reversal and buying setup situations. Let's see. If I miss any of your questions during the session, I'll come back to them, or we'll do some able to see apps slides once more. We'll get to them. 2 of them show force. If you see a candlestick buy signal in the oversold condition, just the very basic premise of candlestick analysis is the Japanese rice traders say if you see a candlestick sell or buy signal in the oversold condition, the probabilities are pretty strong you're going to see a reversal. If you see a candlestick sell signal in the overbought condition, you're probably going to see a reversal. So if you see a candlestick buy signal and followed by a gap, that not only tells you that there was a change of investor sentiment, but now that sentiment is being bought with great enthusiasm. And that's exactly where you want to be buying prices, at the bottom with great enthusiasm coming back into them. Andrew, there's very simple scans for finding the signals and the patterns each day. When I first started using candlesticks, I set up my trading so that I could spend less than 20 minutes each day finding the best 2 or 3 trades out of a trading universe of 7,800 trading entities out there. My game plan was that I would spend 20 minutes doing my analysis. The next morning, I'd spend 45 minutes putting on the first 45 minutes putting on trades, go play golf for the rest of the day, come back for the last 20, 30 minutes, close out whatever I needed to close out, and do the process all over, which was an excellent game plan, except unfortunately I haven't been on a golf course now for 7 years. If you see that doji or a candlestick reversal signal potential at the top and they gap it down, that tells you exactly what you want to know from that reversal signal. They have reversed it with great force. Now, to show exhaustion, if you see a gap up in the overbought condition, the Japanese rice traders have a very simple premise that they graphically can show you where most people buy. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. Everybody's always asking, where do you grab for the fallen knife? Candlestick signals point that out exactly for you. I guess T-line falls when price retraces for some time to return to the original trend. Is there a way to avoid that? No. Oh yeah, there's a simple way. We'll get to that. Can you give the details about scanning? Well, that's a whole different process, but I'll try to. It's very simple. You can write the formulas and put them into any of your scanning software. We've written for the formulas for Metastock, Warden Brothers. We're in the process of doing it for Ninja Trader. We've already got a lot of our formulas over at Thinkorswim, so they're all around. All right, so gap down at the bottom, we're starting to look for buy signals. Now, my overbought and oversold is stochastics. I use stochastics of 1233, slow stochastics. Basically, if you see a candlestick buy signal in the oversold condition, the probabilities are pretty strong. If you see a buy signal and a gap up, probabilities are extremely strong. You're going to be in an uptrend. If you see that gap up in the overbought condition, probabilities are pretty strong that you've probably hit the exhaustion area. It's time to take profits. So if we're looking for this gap up, when do we take profits? It's usually when people in the overbought condition. Yes, the T-line is the 8 exponential moving average. So the doji, just for the quick review, the doji is where they open and close it at the same level during the day. There's your doji star. There's your long-legged doji. The bigger this price move, the more it shows there's indecision. The dragonfly doji opens at the top, trades down, trades back, closes at the top. And then the gravestone doji, the Japanese rice traders explain this as the warriors going out into battle. By the end of the day, they're beaten back into camp, thus leaving their dead all over the field. That's the gravestone doji. Each one of them have very simple implications. The spinning top is a small body, looks like a spinning top. But they all illustrate one thing. There's indecision going on between the bulls and the bears. So very simple rules of a doji is if you see a doji at the top, it's time to sell. If you see a doji at the bottom, you need bullish confirmation to show you that there's a change of investor sentiment. Always pay heed whenever you see a doji because it means there's something going on between the bulls and the bears. And this is the one that makes us a ton of money, which is the trend will usually move in the direction of how they open it after a doji. So if we're in an uptrend, everybody says, well, when do we take profits? And this was one of my biggest problems because if I finally got into a good trade, boy, I didn't want to sell it because this might be the Dell of our lifetime, make us rich. Well, anytime you see that gap up in an overbought condition, very simple rule of a doji, if they open it lower the next day, it's time to take profits. That gap up tells us that's where the exuberance has come into the trading. Now, remember I said if you see a buy signal or close above the T-line, you stay long. There's one caveat to that. The further away you move from the T-line, the higher the probability it is it's going to come back and test the T-line. So this makes it even more visually simple to see when to take profits. If they've gapped up, done a doji away from the T-line, and with that gap up, if they open it lower the next day, the probabilities are that much stronger. They're going to come back and at least test the T-line. Now, what's the worst case scenario? That it comes back to the T-line and does a buy signal and does what we call a J-hook pattern, which is a very strong candlestick pattern. We can always buy back in. My philosophy now is if this is a 10-point move and I only get 8 points of it, but every time I'm in that trade, I know I'm in a positive direction, I want the high, what do I say, probability trade ratio versus trying to grab a trade at the absolute bottom and sell it at the absolute top. The black line is the T-line. The blue line is the 50-day simple moving average. The red line is the 200-day simple moving average. The light gray line is the 20-day simple moving average. Have all these moving averages on our chart for one reason, because every major money manager around the world uses those moving averages to indicate or make decisions about their portfolio. The black line is the T line. Again, very simple. You see a candlestick buy signal, like a bullish engulfing signal. You sell when you see a candlestick sell signal, and they're that far away from the T line. This little green line right here is what we call the 3T line, which is a whole other process for getting us out faster when the price even moves fast away from the T line. So anytime we see this gap up in the overbought condition, we're looking to start taking profits. And if that occurs exactly where we're watching everybody else, or everybody else is watching to see when it's time to take profits, it just tells us pretty early that if we're seeing a gap up spinning top doji right at the 200-day moving average, what should they be doing the next day? They should be opening it positive and going positive. A simple rule of the doji, they're going to move it in the direction how they open it the next day or start trading it. That told us that this was the time to take profits, and our stochastics are starting to turn down. If you see a gap up, get ready to take profits. If I usually have a big profit and I see a doji and a gap up at the top, I'm taking off at least half my position, because that keeps my emotions out of my trading. But that's the probability is telling us it's time to take profits. If it goes higher, at least I'm still in half a position in a high-risk area or a high-risk portion of that trade. If it opens lower, I close the other half, and I can sleep well at night knowing that I got most of that profit out of that trade. The spinning top can be bearish too. Yeah, the spinning top and the dojis are basically the same signal. One just has a little bit bigger body to it. So anytime I see dojis in the oversold condition closing above the next day closing above the T line, I can own until I see that gap up doji and bearish signal. It's time to take profits. So that, again, the doji at the top followed by a gap down tells you not only is there indecision up here, but they've told you which way they've decided on that. So if you see that doji and they open it lower the next day in the overbought condition, you close out the position. If you see a nice steady uptrend like IBM did a while back with a doji, notice what this trend told us. They weren't going to close it below the T line. Now we have a doji gap down below the T line. That pretty much tells us which way they're going to go. That was time to take profits. So if you see that gap down in the oversold condition and starts where this is what we call your best friend. If you see a doji in the oversold condition followed by a gap up, that's your best friend, because that's usually going to be the instigation of a very strong uptrend. Doji, gap up, very high probabilities you're going to be in an uptrend. This is what we, in the doji with other signals, this is a doji followed by a bullish engulfing signal. This is what we call a left-right combo, one of your strongest signals, and then notice what they did the next day. They gapped it up. We're buying immediately. I had somebody ask me a couple weeks ago, how long does it take for your technique to confirm you're in an uptrend? And the answer is, or I would say, they ask how many days? The answer is 0. If I see a left-right combo and they open up positive the next day, that told me exactly what I should be doing. I'm buying immediately. Now, the nice thing about candlestick signals, in the last 40 years of trading, I've heard every money manager tell you to cut your losses short and let your profits run. And in that 40 years, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Candlestick signals do that very simply. If the common sense tells us that if they open this positive, we should be in a bullish trend, and this was the candle that told us the bulls were taking control, very simply, where should this not close? It should not close more than halfway down this candle that told us the bulls were in control. Let's see. What time frame is best? Candlestick signals are the accumulative knowledge of investor sentiment, or the cumulative knowledge of everybody buying and selling during a specific time frame. which means if you're a swing trader like myself, I'm using the daily charts. A longer term investor may use a combination of the daily, weekly, monthly chart. When I used to trade the E-minis, I used a 1 minute, 3 minute, 10-minute chart combination. Right now, when I trade commodities, soybeans, cattle, dollar, whatever, I'm using a 10-minute as my bellwether chart, and then use my 5-minute and 1 minute chart as my entry and exit strategies or points. Let's see. What would prevent you from selling 2 days after getting just above the blue arrow? 2 reasons. One, you're not in an overbought area yet. 2, they didn't close, or they haven't closed below the T line. I guess that's enough. And what do we suspect of this trend after a very strong buy signal and a close above the T line? We better see a strong signal and a close back down below the T line to tell us to be out. Now, that brings the next step, next point of successful investing. Candlestick signals tell you when to be in and when to be out. Had this closed back below the T line, that told me this trade wasn't working. Get back out of the trade. Before candlesticks came along, I was, as I say, I was one of the worst investor in the world. I felt that every time I would put on a trade, it was because I was smarter than everybody else. And when it didn't go up, that was because people as smart as me didn't realize the reason for it to go up, and I'd hold on to it for big losses. Now I know that probably at least 1/3 of my trades aren't going to work, and that's a probability situation. So if I buy something and that trade tells me to get out, I get out and move on to something that has probabilities of moving in the right direction. So anytime I see a series of dojis, if one doji means indecision, a series of dojis means greater indecision. So if I've got a series of dojis and then a gap up through the T line, I know that my next wave is in progress. I know if I see a doji gap up, I want to be buying. Do we always get huge moves like this? Definitely not, but at least you're in a situation where statistically, meaning what the analysis over the last 400 years have shown us, is that you're in the right trade at the right time. Doji, oversold condition, gap up through the T line, you're in an uptrend. We bought this one not too long ago. There's that, what we call a banded baby. They gapped it down and gapped it right back up. Continued this uptrend, gave us a very strong trade. If I see a move back to a support level like the T line, see a doji gap up, that tells me exactly which way they're going to be going. It works with all signals, bullish engulfing signal. If you see a bullish engulfing signal and a close above the T line, and then they start gapping it up, you know you're going to be in a strong price move. There's a big bullish engulfing signal, which is a bullish booster with a tail to it. Notice what they did the next day. This is very simple entry and exit strategies. If we see a candlestick buy signal in the oversold condition, and they gap it up the next day, what's that telling us? That pretty much tells us the bulls are still there. We want to get in right away. Hammer signal followed by a gap up, especially through the T line. This is what we call convergence. If we can put more elements into our visual analysis, such as stochastics in the oversold area, a hammer doji, followed by a gap up and a close above the T line, and they did it smack dab off the 50-day moving average, that's that much more reason to be buying this trade. The T line is the 8 exponential moving average. Notice we had a gap down doji in the oversold area. That immediately tells us to start looking for a buy signal. We start seeing the dojis followed by gap ups. That tells us the investor sentiment has changed. This is your best friend. Doji hammer followed by a gap up in the oversold area. There's going to be a strong price move. If you see that gap down and you see a candlestick signal, that pretty much tells you that that's the exhaustion. That's the panic selling at the bottom. And notice again how far away we've moved from the T line. If I'm buying right in here on these gap ups, what's my first target? remember, we want to be buying if you see a candlestick buy signal and a close above the T line, with the caveat that the further away you move from the T line, the higher the probability is going to come up and test it. So my worst case scenario is going to be I'm buying in here, it comes up and fails, I can see the failure, hopefully I'm back out of that trade with a little bit of a profit or break even. So if I can get out of a bad trade with a profit and break even, that just leaves my money to go find another good trade. There's your banded baby. Where do most people sell? They panic sell at the bottom. A doji hammer gap up, that tells you there's been a drastic change of investor sentiment. A hanging man with a sell signal closed below the T line, that's a downtrend. A hanging man followed by a gap down just tells you with a little bit more force they're going to go in that direction. Piercing signal followed by a gap up tells you reversed. Piercing signal with a big gap up, very strong price move. The dark cloud, start looking for a sell signal, but a dark cloud followed by a down or a gap down tells you that the force is going to be pretty strong to the downside. Shooting star followed by bearish confirmation is a sell signal. Shooting star with a gap down the next day is telling you there's going to be a lot more force to the downside. So this is not rocket science. I use the illustration that all you have to do is be able to see, and you can analyze candlesticks very effectively. And I equate it to the old couple that get ready for bed, and she's standing there in front of the mirror naked, and she said, look at me, my face is wrinkly, my arms are scrawny, my legs are spindly, my butt's spindly, and she turned around to her husband and said, is there anything you can tell me about my body that would make me feel good? And he said, well, your eyesight's still pretty good. So as long as you can see, you can analyze candlestick analysis, because it's merely showing you what goes on in investor sentiment, and investor sentiment has not changed for the last 400 years, and it's not going to change for the next 400 years. The inverted hammer, if they open an inverted hammer positive, nothing statistical or anything official, but I would estimate in my 35 years of candlestick analysis that if they open it positive, especially in the oversold area after an inverted hammer, you've probably got about a 95% probability or greater that you're going to be in an uptrend, which makes the stop loss very simple. If that's the true statistic, what should not happen? They should not open this higher and trade back below this level. If they do, that tells you the bulls aren't there. You close out the position and go on to the next one. There's your ultimate inverted hammer, which is a gravestone doji, followed by a gap up, another gap up. When they start gapping up from signals, that tells you the force is coming back into that trade. Inverted hammer, gap up, just gives you a very strong price move. The bullish harami tells you the selling has stopped. What do you want to see the next day? The bull's confirming. That's a good signal. However, a bullish harami that tells you the selling has stopped, followed by a gap up, is even more compelling, that they've stopped the selling and they're coming back in with great force. So this is what we're looking for on the bullish harami for strong trades, is that gap up. And again, convergence. Downtrend, bullish harami, selling has stopped, support at this level, support at the 50, a gap up, a close above the T line, and then they gap up through this downward trend channel. That tells us that we got a high probability that that's moving to the upside. Oops, I think we did that. Bearish harami followed by a gap down just tells you go short. The morning star signal with a doji followed by a gap up. The morning star signal, the third day needs to close more than halfway above this candle. If they gap it up and close it above the T line, that tells you there's been a definite change of investor sentiment. This little gap up is that much more force that the morning star signal is going to work effectively. Dojis, gap down, evening star signal over here, it's safe. Now here's your strongest signal of all, which is the kicker signal, which has already got a gap built into it, which means they've closed it here, they've gapped it up and gone the opposite direction. You want to be buying this signal immediately, because the probabilities are that there's been a drastic change of investor sentiment, thus the sentiment has been kicked in the opposite direction. It's time to definitely be going long. And it's usually going to produce a very strong price move. That kicker signal is the strongest of all the candlestick signals. And if they do it where they gap it up, especially above the T line, you just want to be a buyer. Again, this is not rocket science. This is just common sense put into graphic depictions that have worked for hundreds of years. This is what we call the flutter kicker signal, which is even more effective, or as effective as the kicker signal. Notice our down day. The next day, they gap it up and do a doji. Well, number one, they've gapped it up above the previous day's open. And what do we know about the simple rule of a doji? It's going to move in the direction of how they open it. So if they open up positive, we don't have to think twice. We're buying immediately because we know if they open up positive, they're going to be trading at positive. And if we took out this little doji, that little flutter, that's essentially a kicker signal. Same scenario on the downside. When they start doing kicker signals to the downside, it's time to go short. So that trading the gaps is basically, with candlesticks, showing you that there's been a change of investor sentiment, and then the gap tells you there's a lot of power going into that new change. This just helps you at buying at the appropriate times. If we see a big fry pan bottom here at a resistance level and they gap it up, that pretty much tells you that this pattern is breaking out. Now, this does two things for you. Now, a few things for you. Number one, it tells you when the pattern's breaking out. Number two, if you're an option trader, it's giving you the ultimate timing element of when to be starting to buy calls, so you're not sitting in something that could be building up. It's telling you when things are actually breaking out. Same scenario on the dumpling top, opposite of the fry pan bottom. Let me go back if I can. Fry pan bottom is this big, slow rounding bottom that you couldn't trade one way or the other, no how. But the criteria is if they start coming out of this pattern with strength, such as a gap up, you want to be buying because the upside potential is going to be very big. Same scenario with the dumpling top, opposite the fry pan bottom. You couldn't trade this anyway at all, but notice when we started rolling over, we had a doji followed by a gap down. That told us this downtrend was going to be fairly powerful. So with candlestick signals and the gaps, we can easily find the support and resistance level, knowing what we should do. Again, there's this dumpling top rolling over, and where's that doji? Sitting right here and kind of on this support level, and they gap it down the next day. Makes our target pretty easy. We know at least they're going to come back and test the 200-day moving average. So if I'm buying puts, I know where my target is. This works on any the candlestick signals with the gaps work on any chart, whether you're on the 1 minute, 5 minute, 10 minute, 30 minute, daily, weekly, monthly. If they start gapping up, it's giving us information. I'm right now in live cattle. This is a live trade. Notice we had a little morning star signal with a doji gap up. When do I cover my long positions? When I see a sell signal and a close below the T line. Is that a sell signal? No, it didn't close below the previous day's low, and so it's not a sell signal. This is a down day and an uptrend. We bought VJet. Again, here's the perfect example of when do you buy your options. Just as they're starting to break this out, gapping it up out of the little fry pan or bottom, we've got huge profits in those trades right now. Now, this is not a exercise to say, yeah, here's all our good trades. If this trade did not work, which meant if they opened this and closed it back below the T line, if we were in the trade, we're back out of it. So it's a perfect setup or a perfect visual analysis to tell you to cut your losses short or let your profits run. This is what we call a classic, where you come out of a fry pan bottom. This is our doji sandwich. Notice how we're trading back up above the T line. The doji sandwich is a bullish day, a doji, followed by another bullish day. We can anticipate that if they open positive after this doji, that we're going to be moving positive, and the magnitude of this move is usually the same magnitude as this move right here, which also tells us that this fry pan bottom is still working, telling us the T-line is working. And then notice what it did the next day. They gapped it up through the beginning of this little fry pan bottom. We were buying calls on, this is SU, Suncor Energy, buying calls at 47 cents, and we closed them out at $3.30 up in this range. Now it is doing what we call the classic. The classic is a fry pan bottom. What do we expect out of a fry pan bottom? A very strong price move. What do we expect after a very strong price move? A potential J-hook pattern. We're buying the calls again. We closed out up here because there's a very simple rule of the candlestick T-line. The further away you move from the T-line, the higher the probability is going to come back and test it. And if you're in an overbought condition and they're starting to gap up, where should the bears not be able to trade this? They shouldn't be able to trade it back below the that candle where it opened. That tells us the bears are starting to take control. What's the worst case scenario? Comes back down to the T-line area. There's our inverted hammer, bullish confirmation, a doji. What's our prospect for the on Monday? If they open this positive, after a doji, they're going to move positive. And we've got the set up for a doji sandwich, and if they're doing the same magnitude move here, that tells us we're up here in the breakout area getting ready for wave 3. So again, this is not rocket science. This is just putting common sense trading patterns that have worked for hundreds of years and just using them to our advantage. So I will take on questions, but before I do that, obviously Pat has set up a special, let me see if I can do this. This is a special where I think this is a package that we usually sell for $130. She's putting the gaps at the top and the gaps at the bottom at the for like $59. Let me see if I can. Oh, I don't even know how to. There I go. Oh, I don't know how to get the link into the chat room. Larry, do you know how to do the link? Okay, all right. Okay, I guess if somebody can stick it in there, then all right. I'll take on any or answer any questions. Whoops! Now I got everything in the way. That's just great. Okay, the only problem I have with GoToWebinar is their font is so small. So let me go back here and I'll try to answer as many questions. Webinar recorded on the cattle. That candlestick pattern was a dark cloud cover. Ooh, I don't know. Let's see. Previous. No. Remember, a dark cloud, and one of the simple elements is a dark cloud has to open above any of the previous day's trading, which it didn't do. This is just kind of a down day and an uptrend. Are these webinars? Yes, these webinars are recorded. How much time do you buy on options? Very simple option strategies using candlesticks. If we're 3, 4, 5 weeks out from expiration, I'm usually buying the calls outright. The candlestick option trading is not a function of trying to find newfangled option trading strategies. It's putting the appropriate strategy with the chart pattern and the amount of time that you have left. So if I'm getting somewhere around 2 to 3 weeks to expiration, because you have candlesticks signals and patterns telling you where the price movement should be moving to as far as direction, and a good estimate of where the target could be, 2 to 3 weeks out, we start putting on bullish spreads, and if it's only 1 week out, we put on credit spreads. So it's all a function of which strategy you put on at the time, based upon what type of patterns you're getting at that time. You could also buy, yes, but credit spread, there's appropriate times to be buying a credit spread, there's an appropriate time to be buying a debit spread, and then there's an appropriate time not to be buying a spread at all. Let's see. An example of time frame combination, please. If I am buying a combination, if I'm buying or trading, let's say I'm trading cattle intraday, I'm owning based upon the 10-minute chart. As long as it stays above the T line on the 10-minute chart, I stay long. If I start seeing it come back to the T line, then I flip to my 5-minute chart and see what my 5-minute chart is looking like. If it's already come back below the T line, I know that the 5-minute chart has to turn around and start back up, or if it keeps coming down, it's going to be pulling the 10-minute chart below the T line. And so if I decide I'm going to get in and out of a position, then I flip to my 1-minute chart and say, all right, what is my 1-minute chart doing right now, and what would it be doing if I extrapolated it into what the 5-minute and the 10-minute chart would be doing? Is that really spinning top? It doesn't really matter whether you call it a doji or a spinning top. It still shows indecision. For these formations are just as effective on Forex. Remember, this is just merely the cumulative knowledge of everybody buying and selling during a specific time frame. It doesn't matter whether you're trading stock, bonds, currencies, tulip bulbs, anything you have fear and greed in. Candlestick analysis will accurately give you the charts telling you what's going on in investor sentiment. The kicker signal is when, see if I can find something that would illustrate a kicker signal on here. I don't see anything. But just for, let's say this was our last candle, and then the next day they opened it here above the previous day's open and started trading this way. That told you not only did they gap it up, but they're going the opposite direction. That would be a kicker signal. Again, that's the most powerful of your reversal signals. Tweezer top. Yeah, that's usually when the price is reversed at the exact same level. We've got people in our chat room that uses the Ikuchumu cloud, I can't even say it, in conjunction with candlestick signals. Oh, what moving averages are all the lines used? The 50, the 200, the 50, and the 20. Those are simple moving averages, and then the T line and the 3T line are both exponential moving averages. And I tell people, don't take my word for it. Throw the T line on your chart and test it. See if your uptrend doesn't stay in progress until you see a candlestick sell signal or close back below the T line. The black one is the T line, yes. What's the trade-off credit spread versus a debit spread? The time factor, there are times when, and the one element of option trading used with candlesticks is very simple. It's the math. What math makes the most sense on that trade for your risk-reward factor? Trying to do a debit spread with maybe only a week to go, you probably have premiums already built into those, let's say those calls. Whereas if you do a credit spread, where you might be selling a put spread, you're getting the benefit. If the price is moving in an upward direction, you're not only getting the intrinsic value going down in the selling the put spread, but you're also getting the that premium that's reducing as the time wears out. Can you show the kicker? Okay, let's see. I forget how far up the kicker signals were. There they are. This was the flutter kicker signal. Notice how we had a open here and a close down here. The next day, they gapped the price up to where it opened above the previous day's open, and the price went this way. That tells you the sentiment, which was going this way, has now been kicked in that direction. Yes, I should have told people not to even think about taking notes. We go very fast because everything's going to be visual. Um, let's see, mark close above the 3T line. Below the 3T line, or wait for the red candle to close. Can we close profit positions when the market closes below the T line, or wait for a red candle to close? Uh, 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 just use a very simple factor. If you see a candlestick sell signal and a close below the T line, the probabilities are there's been a change of investor sentiment. Now, obviously, let's say, for example, this was the Dow, and it opened down here and closed just below the T line, but produced another uh, white candle. You might give it another day to see if that was the end of the downtrend and they take it up. But the next day they would have to take it up back up above the T line to tell you that the market trend was still in progress. I don't know. Did somebody throw the link on in here for people to get? Uh, it is applicable for Forex trading. Because there is no daily bars, you might just use the hourly or whatever time frame you're trading. You buy 70 delta above, and no, don't pay any attention to delta because a lot of the patterns that we trade are based upon a new dynamic coming into that price trend. As you can see, for example, this is kind of a fry pan bottom, but notice what the trajectory or the attitude of this trading was until the fry pan bottom broke out with that kicker signal. That was a whole different delta at that point. So delta doesn't mean anything as far as when we're trading candlesticks. But didn't the live cattle trade below the T line? I don't think so. No, there's this. That's the 3T line. Here's the T line. Now, with it being that far away from the T line, even though it hasn't done a sell signal, there's a good possibility it could come back to the T line. So I'd trade off my 10-minute chart to say if the 10-minute chart is staying below the T line, I'll close it out and wait to see what happens once it hits back at the T line. So if I think something's gotten to an extreme, meaning moved too far away from the T line, yeah, I'll use the 10-minute chart to give me a much faster view of what's going on. How about, let's see again, this font is so small. How about trading futures bond, how to take advantage of the candlesticks if I'm a day trader? Use whatever time frame you're trading, maybe a combination of the 5-minute, 10-minute, 30-minute chart. Or if you're a much faster trader, it might be the 1-minute, 5-minute, 15-minute chart. You just pick out the combinations that tell you or that fit into your trading style. Because again, it comes back to one simple premise. It's the cumulative knowledge of everybody buying and selling during that specific time frame. Do you cover all the option strategies in your, not in these DVDs? No, that's a whole different. We've got option strategies, and we even have a separate option trading room in our on our website for those that are doing specific trades for those option trades. Yes, scanning software is very simple. I mean, it's just common sense. If you can say the formula or the pattern, you can write the formula for it. And now in most of the trading scanning softwares. Again, if you're trading the 10-year and the 30-year bonds, it depends on how fast you're trading. I'd probably still use the 10-minute chart as my bellwether. What time do you trade? Again, I'm usually putting my positions on. If I'm looking for positions, I'm usually a swing trader. So my trading, my stock trading is usually 2 to 10 trading days. But I wouldn't say a day trader on commodities, because the commodity prices move well enough each day that I might take my profits the same day. But I'm still kind of what I consider a swing trader on commodities. It's just that I know I pull the plug a lot faster. Doing a credit spread. Should I do a put spread, or should I do it? Again, that's a whole different session of which spreads to do. Do you consider volatility? And don't have to consider volatility. You can see that right in the chart. And I do consider volatility. If I can see a chart that is going to move, have a nice chart pattern, and it's going to move up 4% over the next 2 weeks, or another stock that has the same chart pattern is going to move up 40% over the next 2 weeks, I'm obviously going to move with the ones that tell me I've got the much better volatility to it. I'm a believer, joined last month and have had profitable trades. Thank you. Okay, thanks, John. The T-line is the 8 exponential moving average. You put it on your charts just like you would the 50-day moving average, simple, or the 200 or any other moving average. How do you use the 3T to influence your trading decisions? For exit signals, that the further away you move from the T-line, the higher the probability you're going to come back and test the T-line. So if you start getting a fast-moving stock price, which we're all looking for, the next question is, when do we take profits? Well, that's when we start letting the 3T line kick in, because if we're way away from the T-line and now we're starting to move away from the 3T line, we're going to be that much more conscious about when a reversal signal might occur. And even though the daily candle might not be showing a sell signal just yet, then we flip to the 10-minute chart and say, all right, I know I'm way away from the T line and the 3T line. What's my 10-minute chart look like as far as, again, the T line and the 3T line? If I start seeing sell signals and I close back below the T line on the 10-minute chart, then I'll start taking profits, even though the daily chart hasn't yet produced a sell signal. With the idea that if the 10-minute chart starts selling below the T-line, which means they're starting to sell, if it turns around and comes back up through the 10-minute T-line, I can always buy back in. That means they're still buying and that they aren't going to create a sell signal in the daily chart that day. What can we understand from position of candlestick up or down the T-line? What can we understand? All I can say there is just use a simple rule. A candlestick buy signal and it doesn't close below the T-line, you stay long. Okay, Bill, I hope you got that. Just put the 8 exponential moving average on your chart. Do you look at direction of the market, say SPX, and decide you want to get in and trade? Kate, the first thing we do is, if I'm going to be swing trading, I want to know which way the market's moving in general. Obviously, we want to be buying longs in an uptrending market. We want to be going short in downtrending market. Or if the market's moving sideways, we might have half our positions long, half our positions short. The nice thing about the candlestick scans is they show you exactly what's going on in investor sentiment in every chart out there. So our scans can pick up in a sideways market. You still have good long positions, and you still have good short positions. So just for money management, we might have 50-50. Right now, we're predominantly long, even though the market's doing a slow uptrend. We've got a lot of pattern breakouts, so fry pan bottoms, J hooks, scoop patterns, all candlestick patterns that tell us as long as this investor sentiment stays just sluggishly slow uptrend, that means the patterns that are being developed, which are built or kind of instigated by investor sentiment in those specific stocks, that as long as the whole market doesn't fall out of bed, those patterns are still going to have high probabilities of breaking out and doing what they should after a breakout of one of those patterns. Can you give us a web address for special? I guess, Larry, did they put up the link? My stochastics are 1233. There's nothing magical about them. Just over the years, I would tweak to see when the stochastics showed oversold right as the trend was oversold, or showed overbought when the price showed overbought. Which stochastics are you using for overbought and oversold? 1233. Do you have all the gap ups to? Do they all have to be gap ups to buy them? No, to buy, what we're looking for is a candlestick signal with bullish confirmation, which is candlestick buy signal with bullish confirmation. But if that bullish confirmation is a gap up, that's that much more reason to be buying that stock, because that means there's a lot more strength coming into that next trend. The gap ups, the candlestick signals followed by a gap up. A candlestick buy signal is going to work with bullish confirmation. A candlestick buy signal with a gap up is probably going to work much better. During intraday trading on minute charts, what would be a gap? Usually you don't get gaps that much during on intraday in the intraday trading, because it's obviously flowing. But occasionally you'll get a gap up, which means there's been a strong reversal, depending on what you're trading. If I'm trading soybeans, there's a lot of times where it's in a downtrend, and then bam, somebody comes in and buys and gaps it up and starts it the other way. But it's much more rare. How much time do you allow for at the open? If let's see, how much time do I have here? If there's 4 quadrants of when to buy. If the market is opening positive, confirming our buying, confirming what we think the market should be doing, and the stock that we're looking for is opening positive, confirming the buy signals, we're buying immediately. And I say immediately. If it opens positive, we may watch it for 30 seconds, a minute, 2 minutes, to make sure it didn't gap open and start selling off. If the market opens lower and the stock opens higher, we just watch it for a few minutes to see if the stock is going to continue higher in spite of what the market is doing. If the market opens higher and the stock that we're looking at opens lower, well, I guess I am out of time. Okay, I guess I'm all out of time.
Hey, Steve. Yeah, sorry. We have to move on to the next presenter, but thank you so much for coming in. Guys, Steve Bigalow of Candlestick Forum, as always, extremely valuable and extremely funny, too. If you guys want to check out Steve's offer, go over to realtraderswebinar.com/candlestick.